Good morning, everyone, or good afternoon, or good evening, depending on where in the world you're catching me from. Great to see all of you once again, and welcome to day two of Retail Rebellion. I see some of you in the chat box. Hello, guys. I see people from Qatar, Ohio, Brisbane, Adelaide, KL, Bahamas, um, from Hong Kong, from Canada, from Thailand, from Quebec, Canada, from Virginia in the US, from Texas, from Nevada, from New Zealand, from Kansas City, from Montreal, and too many to mention, but once again, welcome. And I do hope that you caught day one of Retail Rebellion. Did you guys catch my webinar yesterday? Yeah. So yesterday I focused on how do you invest in the highest quality stocks. I call them the tennis ball stocks. These are companies that generate consistent profits um, every single year. They've got strong economic moats, and these are companies that when there's market panic, they may drop temporarily, but because like tennis balls, they always bounce back. And by investing in these companies, you're able to consistently grow your investments despite the short-term fluctuations. And that's what I focused on yesterday. And how do I buy them at significant discounts to take advantage of market panics? Now, if you missed yesterday's webinar, don't worry, you'll be sent a replay link so you can watch it as many times as you like within the next couple of days. Yeah. And I also hope you caught the webinar by Alson Chu. And Alson focused more on short-term swing trading in stocks, in futures, and in cryptocurrencies, which is his forte. He talked about how market makers manipulate the markets to induce retail traders to panic and sell at the bottom and then get excited and buy at the top. And how you recognize these patterns and instead exploit these patterns to profit alongside the market manipulators. So again, do watch his webinar if you missed the replay yesterday. So today, I'm going to focus on how I trade options, how I generate consistent income every year by trading options. And the way I trade options and the way Bang Fan Van trade options, who, as you guys know, is my options grandmaster, he'll be coming on after me, all right? Now, I've been trading options. Well, I first learned options about 19 years ago. And I can tell you that for the first 8 to 9 years, I was not consistently profitable. I made money, and I lost it again. I made money, I lost it again. So, I went in circles for about 9 years. Any of you experienced that before? You traded options and you made and lost and went around in circles? Anyone experienced that, right? So that was me for 9 years. And I have to give credit that it was Bang Fan Van, who is the options grandmaster, that actually taught me to become very consistently profitable. So in the last 10 years, I have generated few $100,000 every single year, even in the bear market. So I credit it to Bang, right? So I always say that Bang Fan Van is like the Yoda of options. I'm just like this Luke Skywalker. Okay, so you're gonna listen, hear from me first, and then Yoda will be coming after me. All right. So the way I trade options and the way Bang Fan trades options is again very different from most people. Okay. Now, how do most people trade options? The majority of people who trade options, they buy options. They buy options. So, for example, if they think the stock is going up, what do? They buy a call option, right? If they think a stock is going down, market going down, they buy a put option. Yeah. How many of you have been doing that out of curiosity? You tend to buy options more, buy calls and buy puts options, right? Now, that's what I used to do. Okay. Now, the problem with that is remember that options are what? Options are decaying assets. Okay. Options lose value every single day. So when you buy a call option, you need the stock price to go up fast enough and significantly enough to make money. If the price goes up too slowly or the price goes sideways, you lose money. Same thing with put options. You buy a put option, if the price doesn't drop very fast, you also lose money. So the trouble is that when you focus more on buying call options and put options, you find that in the short term, yes, sometimes you can make a lot of money. Sometimes you can make a lot of money if you're lucky, right? But long run, it's hard to make money. Very difficult to make consistent money because the odds are against you. time is working against you. So buying options is like playing the jackpot. It's like buying a lottery ticket. Okay. In the long run, it's hard to make money. Does it make sense? All right. So for Bang and myself, we are very different from other people, right? We focus more on what? Not buying options, we focus on selling options, selling put options and selling call options. Because when you sell options, time is working in your favor and the odds are in your favor. All right. In the long run, you find that you make consistent profits. So we are not like the ones playing the jackpot, right? The ones buying options. We're the ones that own the jackpot machines. We're like the casino where the statistical edge is in our favor. Does it make sense, everyone? Okay. Now, if you're new to options, you may say, I don't know what you're talking about, Adam, right? So later I'll go into the mechanics, but that's the general idea. Now, question, how many of you have traded options before or you've learned about options? Okay. And how many of you are already consistently profitable out of curiosity? And how many of you have been struggling? It's like you're not consistently profitable and it's like really frustrating, right? Okay. And how many of you here have no idea what options are? You've never learned options before. So I have to warn you that if you're new to options, you've never learned it before, at the beginning, it can be a bit challenging. It can be a bit confusing. All right. So if you feel confused about options at the start, there's nothing wrong with you. Nothing wrong with you. It is very normal. Again, when I first learned options over 19 years ago, I was completely lost. Either I'm a slow learner or the person teaching me was not very good. I had to go through the material many, many times over several months before I could understand what's a call and what's a put option. It was so complicated to me. But the moment I got it, the moment I understood, I get it, right? The moment I got it, it was game changing. It transformed the way I invest and the way I trade, you know. And today I can't live without options. In fact, I trade options almost every single day. If you're in my UIP subscription, I send you my option trade as well to tell you what I'm trading in options, right? And today, a big part of my profits and returns comes from options trading. So today, I'm really excited to share with you how I trade options, and I'll do my best to make it as simple as possible. But again, if you're new and you find it a bit confusing, all I can say is don't give up. Don't give up, all right? Ask questions, ask questions, ask questions. And if I can get it, you can get it because I'm not that mathematically inclined, okay? So it can be done. And behind the scenes, I've got a team of coaches who are there to help to answer your questions along the way during this webinar. And at the end of the webinar, I'll do a Q&A session as well. Is that okay, everyone? Yeah? And of course, do take advantage of the big discounts, the 50, 60% discounts of our different courses, mentorship programs, and playbooks, which I'll talk more about at the end of the webinar. Yeah. So with that, guys, let's get going. Now, understand that there are many, many profitable option strategies. In fact, there are over 26 option strategies that we teach in the course, over 26, all right? But of all the strategies, my favorite strategy, personally, is to sell put options on great companies. All right, is to sell put options on high quality stocks. Now, what's a put option? Later, I'll go into greater detail. But basically, a put option is an insurance contract. It's an insurance contract. So basically, I sell insurance on high quality companies. And let me give you an analogy to help you to understand. It is very similar to selling fire insurance on houses. Yeah. So let's imagine that there's a house owner, right? This guy owns this house over here, right? He's a house owner, and the house is valued at $1 million. Now, as a house owner, you're always afraid that what if my house catches fire one day? Yeah. So let's imagine that there's a fire in the bushes, and this house owner is afraid, oh my God, the fire may burn my house down. So what does the house do? Sorry, what? So what does the owner do? He buys fire insurance. Now, fire insurance is basically a put option. It's a put option, right? So he buys a put option. And let's imagine that he insures the house for $1 million. So no matter what happens to the house burns to the ground, he'll get $1 million from the insurance company. The insurance company promises to buy the house for $1 million. So this insured amount is called the strike price. All right, everyone? Do you follow me so far? So far, am I making a bit of sense? All right, so the 1 million is called the strike price. Now, how many of you in real life, you also buy fire insurance or car insurance? I'm sure you do, right? And every year we pay what? What do we pay? We pay a premium. And who collects the premium? Who collects the premium? The insurance company, AIA or Great Eastern Life, right? So I call this Adam Khoo Insurance Company. So every year they collect insurance. Now, what happens if there's no fire? What happens if the house doesn't catch fire? What happens? The insurance contract will expire every year, correct? And the insurance company happily keeps your premium every year. You know, in fact, how many of you complain that you have to buy car insurance every year? And you're thinking, oh, every year I'm paying this insurance and the bloody insurance company just takes my money every year. Those bastards. Okay. How many of you think that way sometimes, right? How many of you wish that you were the insurance company? How many of you wish you were the insurance company, right? So the good news is you can be the insurance company in the stock market, right? So that's what I do. I'm like the Adam Khoo Insurance Company, and I'm selling insurance to investors. And I'll talk again more about how I do it later on. But I want you to understand this house analogy first. Now, you may say, but Adam, what if the house really catches fire? And what if the house really burns to the ground? And the house is worthless and the insurance company has to pay 1 million for the house, then what's going to do, right? So that's why it's very important to only sell fire insurance on metal houses. On metal houses. So you can see this house is made of metal. So metal cannot burn down, right? Metal may catch fire a bit, but after all, the fire goes out and the house is still okay. So you don't want to sell insurance on wooden houses. Do you understand what I'm saying here? Do you understand what I'm saying here? So selling insurance is risky if you do it on wooden houses, but it's very safe if you do it on metal houses. Now, how does this relate to the stock market? Right? How does it relate to the stock market? So now in the stock market, many fund managers, they have got a portfolio of stocks in their funds. Again, instead of a house, they have got many stocks like Amazon and Meta and Google and Microsoft, right? They have all these stocks. And what happens is whenever there's a market fear, like Trump tariffs, or there's a war, or there's a pandemic, these fund managers get scared. Oh my God, the stocks may drop to zero. We're going to die. And the fund managers get very scared. What do? To protect their stocks, what do? What do the fund managers do? The hedge funds. They will buy put options in the stock market. They buy put options, okay, in order to so-called protect their stocks. So if the stocks drop to zero, they go, it's okay, they're insured, right? Now, when they buy put options, they've got to pay a premium. Who collects the premium? Who collects the premium? The person who collects the premium is the person who sells the put options. That's me. That's Adam Khoo. I sell them the put options, right? But again, you may say, Adam, isn't it risky? What if the stocks really go to zero? Now, again, I only sell options on what kind of stocks? I only sell put options on what kind of stocks? On high quality stocks, which I mentioned yesterday. Companies that are very, very strong. They make higher profits every year, and they dominate the industries. Companies like Google, like Meta, like Amazon, like Microsoft. I sell insurance on these stocks because these stocks are tennis ball stocks. They may drop temporarily, but they always bounce back, right? So that's how I'm able to make a consistent profit selling insurance, even in good times and bad. So does this make sense, everyone? Do you understand the concept over here? Okay, so someone asked, why would the hedge fund managers want to buy insurance on high quality stocks? Because they are stupid. No, it's not that they're stupid, it's that they're short term focused. They're just afraid, what if it drops in the short term? Right? So they buy insurance. And I said, who cares? I'll sell you the insurance, right? Because even if I get the stock, I've got the holding power to hold it until it recovers. And good companies would rebound very fast once the market turns around. All right. So that is the whole idea. Now, I have got two main accounts as I showed you guys yesterday. So for example, this is my first account over here. And this account, yeah, it's 7398, just to make sure I'm transparent with you. This account is about $5.2 million worth. And this other account is 6956. That's my IB code. And this is about $5.7 million. So these are the two accounts I have. And by the way, these are some of the put options I sold recently, as you can see. I'll go through them in a while. So how have I done? Again, not to impress you or to show off, but to be transparent and to show you that these profits are real, right? So for the last 12 months, which is from July 2024 last year to July now, I just printed this out. My first account I showed you, I made a net profit of $173,000, right? You can see over here, when I sell options, I collected $500,000, 506,000. When I buy the options back, I got to pay for it, 332,000 negative. So net, I made $173,000. That's my first account. My second account, right? I sold 438,000 of options. I bought back 277,000 of options. My net profit 161,000. So my two accounts over the last 12 months, my net combined profit $334,000. Now people ask me, to get this 334,000, how much capital was required? We call that the buying power required. Now the buying power I use, right, is about $250,000 combined, right? That's because I use a margin account, which you need as an option seller, you need a margin account. So my actual return on capital is about 133%. It's over 100% return on capital, right? Now, how about previous year? So previous year, you can see this was Jan to December 2024. Account one, all right, I made 99K, so I made less last year. Account two, I made 93K. My combined profits last year was 192,000. So not as great as this year. So this year has been actually very, very good. Then people say, Adam, in a bull market, when the stocks go up, of course you do well. What about bear market? How about when the market crash? So the last bear market was 2022, right? In 2022, I made 267,000. Okay, I sold 1.15 million of put option contracts. I bought them back at 800,000, 67,000. I made over $250,000. Okay, so just to show you that it's been profitable in bull markets and bear markets. Now, let's go down to the mechanics. Oh, by the way, what I'm making and what Bang Fan is making is peanuts. It's peanuts. Guess who makes a lot more money than us? Guess who is the world's biggest options trader? The world's biggest options trader is actually none other than Warren Buffett. Yeah, and many people don't know this. Many people don't know that Warren Buffett actually is the world's biggest options trader. Why? Because he never talks about it. He never ever talks about it, right? But if you read the financial report from Berkshire Hathaway, you know that Buffett trades a lot of options. He's the biggest option traders in the world. Okay. And the good thing is that Buffett's favorite strategy is the strategy that I am teaching you today, which is what does Buffett do? Buffett also focuses on selling options. Buffett never buys options. He never buys options in his whole life. Okay, he only sells options, and he focuses on selling put options. In fact, during the financial crisis in 2008, any of you old enough to remember the financial crisis? During the financial crisis, when the whole market dropped 50%, many people panicked. They said, "Oh, we're going to die," right? And what did they do? They bought a lot of insurance on the stocks. They bought put insurance. And who sold them all the put insurance? Who sold them all the put insurance? Warren Buffett. And Buffett sold them all the put options, and he collected $4.9 billion in premiums. 4.9 billion in premiums selling put options. Yeah. And many years ago, Buffett wanted to own Coca-Cola shares. Instead of buying Coca-Cola shares directly, he sold put options on Coca-Cola shares and collected 7.8 million in premium on Coca-Cola shares. So if Coca-Cola didn't crash, Buffett would just keep the 7.8 million free premium money, right? But when Coca-Cola dropped, then Buffett was obligated to buy Coca-Cola at a big discount. So either way, he win. By the way, this is not surprising. How many of you know what is Buffett's main business in Berkshire Hathaway? How many of you know what is Warren Buffett's main business? That's right, insurance. Correct, insurance. So now you know that he is mainly an insurance company. That's why he sells put options. So you can be like Buffett in a small way, right? You can be like AIA, you can be like Great Eastern Life, selling insurance. So are you now motivated to learn how? All right, so again, credit goes to Bang Fan Ban. He's the one that actually told me, Adam, you must sell insurance. I said, huh? How? So 10 years ago, he said, this is how you do it, all right? Okay, so let's, again, for those of you who are beginners, let me do my best to explain step by step, yeah? So first of all, what's a put option? What's a put option? A put option is a contract. It's a contract, okay? Now, if you buy a put option, you have the right, to sell 100 shares of a particular stock. Let's say Apple, okay? You have the right to sell 100 shares of Apple at a price that you have locked in, that you have assured. That price that you locked in is called the strike price. So you can sell 100 shares of Apple at a certain strike price anytime before the expiration date. So like I said earlier on, it's like buying insurance. So for example, if you buy a put option on Apple, you buy a put option on Apple at a strike price of $200. What does it mean? What does this mean? This means that you have the right to sell Apple shares at $200. So no matter what happens to Apple shares, you can still sell it at $200. Even if Apple drops to zero tomorrow, you can still sell it at $200 because you've locked in the sale price. And you can sell Apple at $200 anytime before the expiration date. Now you may say, what's the expiration date? Well, you can choose any expiration date in the market. You can buy a put option that expires in 30 days, 60 days, in 1 year, in 3 years. It's up to you. All right. Same thing. You can sell a put option on any expiration date, on any strike price that you choose. So let me give you another example. Right? So let's imagine now this stock is called Visa. And Visa is now selling at $280. And you are a fund manager. So you own Visa stock. And suddenly you panic. You say, oh my God, I think the market's going to crash because of the tariff. Visa is going to go to zero. Oh my God. So what do you do when you get scared? When you see the market is volatile, you want to buy put options. You want to buy insurance, right? So when you go into the market, you can choose all these different put options. Okay, so for example, you could buy a put option with a strike price of $280 strike price. This is called the strike price, by the way. This is called the strike price. Okay, so what does this mean? If you buy this put option, that means you have the right to sell Visa at 280. You have locked in the sales price at 280. Understand? And if you buy this option, you have to pay the premium. And in this case, the premium is $8.40, for example. Now, one contract is always 100 shares. Okay, one contract is always 100 shares. So if you buy this put option, how much must you pay? How much must you pay? You must pay $840. Okay. Now, this fund manager can also choose to insure his stock at 275 strike price. So if Visa drops to zero, he can sell the stock at 275. So he only lose $5 at the most, right? So because the strike price is lower, he insures for lower value, right? The premium is cheaper. Or he can also buy the put with a 270 strike price so that Visa goes to zero, he can sell at 270. And of course, that is cheaper. Now, he can also buy at a higher strike price where he insures it for 290. So if Visa goes to zero, he can sell Visa at 290. And of course, that is more expensive. Understand? So you can choose any put option. You can choose any strike price. Right? So let's imagine that the fund manager decides to buy this put option. Okay, he buys this put option to protect his stock that he's afraid will go to zero. How much does he pay again to buy this put option? That's right. He pays 560. Who does he pay to? Who does he pay the premium to? Who does he pay to? He pays it to the put seller, who is, I'm the insurance company, right? Okay. So let's imagine that Visa really drops. Let's say Visa really drops, not to zero, of course, but let's say Visa drops by half. Visa drops to $140. Now, will the fund manager be happy now? Will he be happy? Yes, he's very happy, right? Why is he happy? Because he has the right to sell Visa at 270. But now Visa is at 140. So even though Visa dropped to 140, he said, it's okay, doesn't matter because I can still sell it at 270, right? Because he's locked in the sales price. Understand? So theoretically, he could sell his Visa stock, which is worth 140, he could sell it at 270. And what is the difference between 140 and 270? What's the difference between 270 and 140? Okay, the difference is $130, right? So that means the put option that he bought is worth at least $130. I repeat, the put option he bought is worth at least $130. That's called the intrinsic value of the put option. Okay, because the put option has got an inbuilt $130 in value. So he bought the put option for 560, right? But now, because Visa stock dropped, the put option is now worth at least $130. The put option increased in value. Okay, so what could the fund manager do? What could he do? Well, there are two things he could do. The first thing he could do is to simply exercise the put option and sell his stock at 270. So if he sells his stock at 270, he only loses $10, right? He only loses $10 instead of losing half. You understand? Or the fund manager could keep his shares but he could sell the put option for profit. So he bought the put option at 560, he paid a premium, then now he sells it at 130. So what profit does he make? What's 130 minus 560? He makes a profit of $124.40. Right? So that is what the fund manager does. So the fund manager will only benefit if what? The fund manager will only benefit if Visa stock drops a lot. Correct? It drops a lot and it drops very fast before the option expires. You understand? Okay. Now, what happens if Visa stock doesn't drop very much? Okay. So again, he buys the put option at 270. Okay. And then Visa, instead of dropping, let's say Visa share price goes up, or the share price goes sideways, or the share price goes down, but doesn't go below 270. Let's say it goes right at 270, or it may even go below 270, but by the expiration date, it gets back to 270. So in all these scenarios, what happens? If Visa doesn't drop very much, or it doesn't drop fast enough, then what happens? Then this put option becomes worthless. It becomes worthless, right? And the fund manager will lose $5.60. And the person who sold him the put, which is me, I will just keep the $5.60. Yay! You understand? So it's kind of like he buys the fire insurance, but the fire doesn't burn the house down, or the fire doesn't reach the house in time. Okay? And he just, the contract expires, and he just have to keep paying the premium again and again. Does this make sense, guys? Okay. So far, am I clear? Or did I confuse you more? Clear? Okay. Now, let me show you a different visual, okay? So again, in the market, there are two roles you can play. You either be the person who buys the put option, or you're the one who sells the put option. You can play either role, right? Now, again, the person who buys the put option, he pays the premium. And who collects the premium? The put seller receives the premium. Correct? Okay. So this guy buys insurance, this guy sells insurance. Now, this put buyer who buys the insurance, he has the right to sell the stock to the put seller at the agreed upon price. In this case, $270. Okay. And of course, the put buyer is hoping the stock price will crash. He's hoping the stock price would crash very fast. If the stock price crashes, the put buyer will make money because the puts will be worth more and he can sell it for a profit. Or the put buyer can simply exercise the put and sell his shares at the strike price. Okay. Now, for the put seller, he receives the premium. So why would the put seller want to sell the put? Because he gets the premium, right? He gets the premium. But by collecting the premium, the put seller is what? He's obligated. He's obligated to buy the 100 shares from the put buyer at the agreed upon strike price at 270. Let that sink in for a while. As a put seller, you sell the insurance, you collect premium, but you're obligated to buy the shares at the strike price. Okay? Now, so for the put seller, if the stock price goes up, right? If the stock price goes up or the stock price goes sideways, what happens? The put will lose value, and expire worthless. And the put seller goes, yay, it's worthless. I'm no longer obligated to buy the shares. He just keeps the premium. The house didn't burn down. I just keep the premium, right? But again, what happens if the stock price really drops? What happens if the stock price really drops? If the stock price really drops below 270, let's say the stock price drops to 250 and it stays at 250 by the expiration date. So now what happened to the put seller? Now the put seller is obligated to buy the shares at 250, correct? When the price at, okay, sorry, let me repeat that. Salah, okay. If the stock price drops to 250, the put seller is obligated to buy the shares at 270. All right, so as a put seller, I'm obligated to buy shares at 270, even though now the share price is at 250. Okay. Now, is this risky? Yeah, you got to buy at 270. Now the stock price below 270. Yeah. Is that risky? It depends, okay, on the type of stock. So if you sell put options on risky stocks, companies that don't make consistent profits, then it's very risky because the stock price can drop below 270 and never come back. And never come back. And then you really lose money. It's like the house burned down, right? There's no more house. Okay. But for me, I'm very strict. I'm very disciplined. I sell put options on tennis ball stocks, on very safe companies like Amazon, ASML, Microsoft, that even though the price may drop temporarily, but they will always what? Boom, bounce back, right? So even if I buy the shares at 270, all right, and the share price is below that, in a while it'll bounce back and I can sell it for profit. Are you with me so far? So the whole key is you only do this on very, very safe companies. If you do this on speculative companies, like for example, do you think I'll dare to do this on Tesla? Do you think I'll dare to sell put options on Tesla? No, because Tesla has a lot of competition, right? They're competing with BYD, so much competition, and the stock price is very overvalued, and the CEO is a bit political, right? So there's a lot of uncertainty. So I wouldn't dare to do it on Tesla, yeah. But I'll dare to do it on Microsoft. I'll dare to do it on Coca-Cola. These are very, very consistent and predictable companies. Okay. Yes, I only do it on US stocks, only on US stocks, because other markets, the options do not have much liquidity. So I used to do it on Hong Kong stocks. I used to sell put options on Hong Kong stocks, but the premium is not attractive because the liquidity is very low. No, I'm not saying that Coca-Cola likes competition. Of course, Coca-Cola has competition, but it makes consistent profits. All right. And it's one of the dominant companies. Understand? Okay. Okay. So let me now go into the exact strategy details. So far, are you guys following me? Right. Okay, good. So the first strategy I'm going to share with you is what is called selling cash secured puts. Okay, selling cash secured puts. So again, this is a strategy used by Warren Buffett. Now, so what does this mean? This means that I sell put options that are cash secured. Now, that means that I must have the cash ready to buy the 100 shares. I must have the cash ready to buy the 100 shares if I get assigned the 100 shares. That's why called cash secured. If you sell a put option and you don't have the cash to buy the shares, that's called selling a naked put. And you should not do that. That is very, very risky. All right. Now, some of you may say, but Adam, I don't have a big account to own the 100 shares. I don't have so much cash. Then later I'll show you another strategy, which I use as well, where you can do this with a very small account. That even if your account is like $2,000, 3,000, you can do it as well. But that's later. For now, let's talk about selling cash secured puts. So selling cash secured puts allows me to buy stocks that I want to buy at a huge discount from the market or even for free eventually. All right. So let me show you step by step how I do it, and I'll show you some examples. Okay. Now, first of all, I tell you what, let me go to my drawing board, and I find it easier to explain while drawing. Okay, great. Now, the first thing is this. Number one, you only do this on what? High quality stocks that are the top 1% of stocks in the market. Okay. And these are stocks that you don't mind owning. You want to own the shares. You want to own 100 shares. Okay. Now, let me ask you this. A good company, as you know, will always go up, right? The share price will always go up in the long run. Yeah. But does it go up in one straight line? It doesn't go up in one straight line. So how does the stock price move? It moves in wave patterns like that, right? So watch. Wave up, wave down, wave up, wave down, wave up, wave down. Now, I only sell a put option after a wave down. I repeat, I only sell a put option after a wave down. Okay, you must see the price drop first. Never sell at the top. Always sell after it drops. And it should drop to what is called a support level. Okay, so let's imagine this stock that I want to buy, the price drops to here. And let's say this is, let's say, $100. The other thing is you want to make sure that you only want to buy when it's undervalued. Only buy when it's undervalued. So it must be selling below the intrinsic value. So let's say the intrinsic value of this stock is 150. Now, if you have got the Stock Oracle software, which I showed you yesterday, Stock Oracle will show you the intrinsic value immediately. Okay. Now, let me ask you, if this stock intrinsic value is 150 and now the price dropped to 100, could you buy it? Could you buy it? Yes, of course, right? Good company, undervalued, I buy it, right? Okay, good. But let's say you want to play hard to get. You say, you know what? I'm very stingy. I don't want to buy at $100. I want to buy even lower. So I want to buy at, let's say, $90. Okay. Now, if you want to buy it at $90 when it's at $100, what can you do? You can just wait. You just wait, and hope that the price drop to $90, right? If it drops to 90, then you get to buy it. If it doesn't drop to 90, then you don't get to buy it. Okay? Now, instead of waiting there like an idiot, drop, please, drop, I want to buy, right? Instead of waiting there like an idiot at $90, what could you do so that you get paid for waiting? What could you do to get paid for waiting and buy at 90? You sell a put option. Very good. Okay? So, understand? So, instead of waiting to buy at 90, what I do all the time is I will sell. Okay, hold on. Let me draw it here. Okay. I will sell a put option at a 90 strike price. Okay. 90 strike price. So again, why do I sell this put option? Because when I sell a put option, I collect what? What do I collect? I collect premium. And my rule, I want to collect at least 2% premium. Okay, so what's 2% of $90? What's 2% of $90? is $1.80, right? Is it correct? Yeah. Right. So I want to collect $1.80. And normally when I sell a put option, I will sell a put option that expires within 30 to 45 days. That is my rule. Okay? Understand? So once I sell the put option, now the moment I sell the put option, I collect the premium upfront. The cash is credited into my account. So I get free money. Okay. But once I sell the put option, what happens? I'm obligated to buy the shares if it drops below 90 and stays there by expiration. Okay. So if the stock price doesn't drop to 90, let's say the stock price goes up, the stock price goes sideways, the stock price goes down, but doesn't go below 90, then what happens? If the stock price never goes below 90, or it goes below 90 but goes back up, then what happens? Then the put option will expire in 45 days and I just get free money. I keep the free money and I do this every month. I sell the put, collect money, sell the put, collect money, sell the put, collect money. So that's how I collect money every month. Understand? But if the price drops below 90 and stays there, what happens? Then I'm obligated to buy the shares at $90, which is very good deal, right? But not only do I buy at $90, I keep the $1.80 premium. I keep this premium. So what's my net cost? What's my net cost? It's $90, which I pay for the shares, but I collect 180. My net cost is $88.20. So can you see that I'm able to buy the stock at a discount to the market? That is how Warren Buffett buys stocks. He sells put options. So he buys at a discount from everyone else. This is one of his secret strategies that he never talks about, but he does it. Okay? So, question someone asked, why do I choose 30 to 45 days expiration? Good question. Because if you learn options, you know that options tend to lose value the fastest in the last 45 days. The time value decays the fastest in the last 45 days. So never sell more than 45 days. If you sell more than 45 days, the option takes very long, it's very slow to lose value. You want it to lose value as fast as possible. Okay? Why minimum 2%? Well, that's my own rule, right? I want to get at least 2%. If you can get more than 2%, better still, right? You get 3%, 4%, very good, right? But ideally, at least 2% or sometimes 1.9, right? Somewhere around there. Okay. Now, when you sell options on stocks, they are all American style options. Okay. If you sell options on indexes, they are European style options. But I don't sell on indexes. I sell them on good companies that I want to own, right? Okay. So this is the general idea. Let me show you specific examples, all right? Just to check, can you guys understand what I'm saying? Now, for those of you who have never learned options before, you are probably totally lost right now. It's like, what the hell is he talking about? so, so I don't blame you. It's not your fault. Like I said, if you're learning for the first time, you'll be totally lost. Confirm lost. Because I was also lost when I first learned it 19 years ago. But if you have learned options before, then you should be able to follow what I'm saying. Yeah. And if you're lost, don't give up. Don't give up. Okay. Yeah. Watch this a few times, take the courses, and we will handhold you step by step. All right, with weekly live webinars until you get it. Yeah. Why not indexes? Because I don't want to own the index. I don't want to own the index. I want to own good companies only, right? That's the reason why. Okay. So let me show you some actual examples. Okay. So let's look at this example on Fortinet. All right, Fortinet is a cyber security company, right? FTNT, and is this a great company? Is this a great company? Yes, it's a very good company. I own a lot of the shares. And so it's a very strong company. And the intrinsic value at the time was $82. Okay, it's $82. Now look at the share price again. Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. So now it waved down here. The share price here was $81.39. Okay. Now, could I have bought it here if I wanted to? Yes, you can sell puts on ETFs as well, no problem. But normally ETFs, the premiums are not attractive, so I don't really do it. Okay, now, of course, I could buy the 81.39, but I want to be greedy. I want to play hard to get. I want to get discount like typical Singaporean. So instead, I want to buy the shares at $72. So I could wait like an idiot at 72, wait there, please come down, right? So instead of waiting like an idiot, what did I do? I sold a put option at the 72 strike price. And I collected a $1.50 premium. Okay. So I get $1.50 out of the $72 strike price. So how many percent is that? That's 2%. Very good. Okay, I got a question from someone. Adam, how do you decide it's 72? Very good question. Later, I'll show you. The strike price that I choose is based on the delta. Okay, it's based on the delta and based on the premium I can collect. So I will choose a strike price where I collect at least 2% premium. At least 2%. So that's how it's like. Must get at least 2% premium. Okay. And the delta should be about 30 delta. So what does 30 delta mean? 30 delta means there's a 30% chance that the option will be exercised and I'll be assigned the shares. There's a 30% chance. Okay. Now people ask me, can I sell at 20 delta so there's a less chance to get the shares? Yes, you can. Can I sell at 10 delta? You also can do that. There's no right or wrong, right? But my style is I sell at 30 delta and I want to collect at least 2% premium. Okay, so that is my own style. Now, this option I sold expired in 39 days. Okay, on the 6th of December. Yeah. So let me show you. This was the trade notification I sent out to my subscribers. So those of you who subscribe to UIP, you get all my trade notifications. So once I enter a trade, I'll do a screenshot and I'll send it to you and I explain why I entered the trade, blah, 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 right? So you can see over here, I sold a cash secured put on Fortinet at 72 strike price, 6 December expiry, collected $1.50 premium per share. All right, and this was a screenshot. As you can see, I sold at 150. All right. So if Fortinet stays below $72 by the expiration date, I'm obligated to buy 100 shares at $72. Less the premium of $1.50 I collect today, my net purchase price is $70.50. If Fortinet stays above $72 by expiration, I'll keep the 150 premium. All right, so I explain all the trade I do. Okay, now what are the different scenarios? What are the different scenarios? So again, this is the same chart, except I have magnified it, right? So again, the current stock price was 81.39. This is the share price where I sold the put at 72 strike. Okay, so I sell the put below the market price. Okay, and expires in 39 days. I collect 150. Now, scenario number one. Listen very carefully, everyone. Scenario number one is that after I sell the put, Fortinet share price stay above the strike price by the expiration date. That means the share price go up, or the share price goes sideways, or the share price even goes down, but doesn't go below 72, right? It goes, yeah, ah, right? Now it can go below 72, no problem, but before it expires, it goes to 72 or above, right? So in all these scenarios, what happens? In the first scenario, when the price stays above 72, what happens? The option will lose value, lose value, lose value, lose value, and eventually become worthless. Worthless. And I just keep the premium. And I'll just keep repeating the process. So every month I sell the put option, expire, sell the put option, and so I keep repeating, right? So if I can collect 2% a month, is that a good deal? 2% a month is 24% a year. Better than Along. Better than being illegal money lender, right? Not bad, right? Yeah. So that's what I do. Now, scenario number two. What happened if the share price fall and stay below the strike price by the expiration date? So let's say the share price drop below 72, and let's say it drops to $70 and stays there by the expiration date. What happens? Then, if I let it expire, if I let the put option expire, then I'll be obligated to buy the shares at $72. Okay, so I need to have the cash ready to buy it at $72. I must have the cash ready to buy. Okay, but remember, I already collected $1.50 up front. So 72 minus 150 net, my actual purchase price is $70.50. So either way, I win. Stock price don't go down, I get free money. Stock price go down, I buy at a discount. Either way, I win. But again, you only do this on good companies you want to own and you have the cash to buy. You follow? Okay, now, let's say, hold on, let me just double check something. Let's say the share price drops below 72 and is going to expire below 72, but I don't want the shares. At the last minute, I decide, no, I don't want the shares. I decided not to own the shares. I don't want the baby. I don't want the baby. What can I do? What can I do if at the last minute, I don't want to own the shares? I don't want the baby. Can go for abortion or not? Can. Can. So if at the last minute, before it expires, normally what happens is about 1 to 2 days before it expires, if I decide I don't want the shares, then what will I do? Then I will buy the put option back. I'll buy the insurance contract back. All right. But I'll buy it back for a loss. Now, see, when I first sell the put option, I collect 150, right? But now that the stock price drop, the put option is more expensive. So I have to buy it back for a loss. I have to buy it back for a loss. So let's say I buy it back for $2 for $2. Okay, so how much do I lose? I will lose 50 cents. Okay, so I repeat, if I don't want the shares, then I'll buy the option back. So I'm no longer obligated to own the shares. So I'll buy the put option back at a loss, but simultaneously, I'll sell another put option. I sell a new put option with a further expiration date, another 30 to 45 days at the same or lower strike price. So I collect the new premium in order to offset the loss of the put that I bought back. So what is this called? This is called rolling the put for a credit, right? So if I change my mind about buying the shares, I can roll the put lower and further in time for a credit. So this is what I do during a bear market. In a bear market, if the share price keep dropping, and I say, I don't want the shares, I decided I don't want the shares, what do? I buy the put back for a loss, I sell another put. And the premium from the new put cover the old put. And then I keep rolling. Sometimes I may roll it 2, 3, 4 times until the price rebound and the option expires. All right. So that's what I do as well. If I don't want the shares, I will keep rolling it. All right. Now, again, if you're new to options, then of course, I know it's a bit confusing. I don't expect you to understand everything the first time because I also didn't understand when I first learned it as well. It took me a few weeks, a few months before okay. But once I could understand, it's like magic, right? It becomes like a new business for me, being an insurance company. Yeah. But are you a little bit clearer for those of you who understand options? Now, like I said, this strategy, you need more capital because you need the cash to buy 100 shares. So if you don't have a big account, then you can use another strategy, which I'll show you next, which is called credit spread. That one requires small account. Okay, this is for bigger account. This is for bigger account, right? So these, by the way, just to share with you, right? Now, this Fortinet, which I sold, it expires in how many days? How many days does it expire? It expired in 39 days. Okay. Now, in reality, do you think I will wait for 39 days? Do you think I will wait for 39 days until it expires? No, I won't. No, I won't, right? So normally, once the put drops in value, I will buy back within about 20 days or less. Okay, so in this case, I sold the put at 150, right? I sold it at 150. And you can see what happened was that by the 8th of November, okay, the put the price of the put dropped to 7 cents already. So I closed the trade. I bought the put back for 7 cents. Okay, and this was after 11 days. That means after 11 days, I closed the trade. So I sold the put for 150, right? I collected 150, but I bought it back at 7 cents, which I alerted all my members. I bought it back at 7 cents. So I don't make the full 150, but I made $1.43, which is 95% of the profit I realized. And I don't have to wait another 20 days, 20 plus days. You understand what I'm saying? Right? So you can see these were all the trades, right? So I closed Microsoft at 85% of max profit. I closed Google at 80% of max profit. I closed Yum Brands at 70% max profit. So I don't always wait for the expiration. I buy back early, I buy back early, I buy back early. So I can keep recycling. Okay. So normally, once I get 75 to 80%, I'll buy it back. Instead of waiting another 15 days to get the last 10%, it's not worth it. Okay. Okay, this was a trade I did recently, just 2 weeks ago, all right? Two weeks ago, right? So let me show you why I did this trade. Okay, so this is Amazon. Okay, so Amazon, you can see wave up, wave down, wave up, wave down. Can you see here? So on this day, when Amazon dropped to 209, what did I do? When Amazon dropped to 209, first, Amazon's intrinsic value is 221. That's the intrinsic value. So is it undervalued? Yes or no? Yes. Could I buy at 209? Could I buy at 209? Yes, I could. But I want to play hard to get. So instead, I sold a put option at 200 strike price. Okay. So I sold the Amazon put option at 200 strike price. I collected $5.44. You can see up here. I collected $5.44 and it expired in 40 days. So I got 544 out of 200. How many percent is that? That's 2.7%. Is that a good deal? 2.7%, not bad deal, right? And I get it in 40 days. So I thought it was a good deal. So I sold this put option here, and you can. So what happened was I bought the put back. Okay, where was that thing? Yeah, so I already bought the put back already. In fact, let me see. Yeah, I already bought this put back. So let's take a look, and let me show you a live example right now. Okay, let me show you a live example right now. Oh, by the way, how many of you heard of ASML? Now, what happened a few days ago? Can you see ASML? They announced earnings and the price dropped. Right? And it dropped to this support level 729. Can you see that? So what do you think I did? Once the price dropped to a support level, I went to sell a put. Correct. So this was the notification that I sent out to my subscribers. Yeah. Where is it? Yeah, there. I sold a cash secured put on ASML at 685 strike price and collected $14.20 premium per share. All right. And this trade is still open. I've not closed it yet. Let me just show you where the trade is. There. Can you see here? So I sold the put at $14.20. Okay. And since then, after I sold the put fall in value because of the time decay. So now how much is the put worth? How much is the put worth now? How much is the put worth? $9.76. So if I buy the put back now, I will get $444 in profit, right? But it's too early to buy back. So I'm going to wait for it to drop to maybe $2 or $3. Then I can realize about $1,000 profit on this one, right? So let's look at an actual example right now. So let's say we look at this stock called Essential. Now, is Essential a good company? Now, if you're not sure, you can go to Stock Oracle and look at Essential. You can see it's got a white mode. You can see the intrinsic value is 325. So now at 282 is selling at a discount, right? And you can see predictability high, profitability high, growth medium, mode strong, financial strength strong. So it's quite a strong company like that, right? It's quite a strong company. Now, will you do this for Intel? Do you think Intel is a strong company? No. Why? Like if you put in Intel, you can see, right? Low predictability, low profitability, medium growth, weak mode, right? So it's not a strong company. You want to see at least medium or high for most of the criteria. Okay. AMD. AMD is not bad actually. Let's look at AMD. AMD is not bad, right? You can see AMD is a medium, medium, high, medium, high. But let's see, is it undervalued? No, it's overvalued, right? So you can see that right now AMD is slightly overvalued. So I will only sell a put if it's below the intrinsic value. Okay. So anyway, if you get Stock Oracle, you can analyze stocks very quickly, right? Nvidia is a good company. TSMC is a good company. All right. Yeah. Okay. So let me show you a real life example. Okay. So let's say now Accenture has dropped to 282. Can you see? Now it's at $282. Okay. And is there a support level here? Is there a support level? Yes. Now, of course, first you must make sure you don't mind owning the company. You may say, I don't mind owning Accenture. It's a good company and the intrinsic value is about 300. I buy at 282 is a good deal. Okay. If you don't mind owning the company, then you can sell a put. Okay. So let me show you how I sell the put. Okay. So now in the options course, we will be using interactive brokers as well. Okay. So you learn how to do it on interactive brokers. Give me a second. Okay. So first of all, when you sell a put, you have to choose the expiration date. Okay, see? Choose the expiration date. So how many days to expiration do I choose? Do I need to own the company share? No, you don't. 30 to 45 days, okay? So I could either choose 26 August or I can choose 29 August. So let's choose this 29 August, 41 days. Then I look at the put option and I look at the different what? Strike price. You see? So how do I choose the strike price? I want to choose a strike price so that I get close to 2%. And the delta is about 30 delta. So where is about 30? Either this one or this one, right? Either 270 or 275. I can sell either one. Now, if I sell 270, what is the premium I get? I'm getting 390 premium. So 390 divided by 270, what's that? What's 390 divided by 270? Only 1.4%. Is it attractive? No, not attractive. So I won't sell this one, right? Now, how about this? I sell 275 strike, I collect 530. 530 divided by 275 is 1.9%. Um, it's not great, right? Because I want to get at least 2%. Yeah. So, but for the purpose of this example, I'll just use it. Okay. So let's say I decide to sell this. Okay, I sell this, right? So I can sell the put. -1 means one contract, and I will aim to collect $5.30. Can you see? So if I do that, so that means that I sell a put at this strike price and I collect $5.30. So one contract is 100 shares. So if I sell the put, I will collect $530 cash in my account. I collect the cash in my account, collect upfront. But I'll be obligated to buy what? I'm obligated to buy 100 shares at 275. What is 100 times 275? Is $27,500. So you need to have the cash to buy this. If then we call it a cash secured put. Now, if you say, Adam, that's too much money, I can't afford to have 27,000 cash to buy this stock, then don't sell the put. Instead, do a credit spread, which I'll show you next. So credit spread are for those of you who have got small account and you don't want to own the shares. Then you do a credit spread, which requires much less capital. All right, so that is coming up later. I want to teach you this first. Yeah. So far, is this useful, guys? Do I only sell one contract? No, sometimes I sell 10 contracts, 5 contracts, 3 contracts. It all depends. Okay. So let me move on. Okay, great that you guys find it useful. Okay. By the way, this is my students' favorite strategies as well. Yeah. So this is one of my students, right? And she said, hi, Master Bang and Adam. By the way, she's from Japan. Marie's from Japan. She says, hi, Master Bang and Adam. I've been trading for years, but I only knew single call and put options. I was making a lot of money. Then I lost almost all my profits. After that, I made more money, but then I lost profit again. I was just going around in circles. Yeah, sounds exactly like me last time. After I joined Piranha Profits in 2020, I studied so hard to master option strategies. And under Bang and Adam's guidance, I'm making consistent profits with confidence without stress. I can sleep through the night, and every day I'm so excited to trade and invest without any fear. This year alone, I'm up 35,000 for the first month, right? Joining Piranha Profits was the best thing I've ever done in my whole life, right? And this other lady is also an inspiration. Her name is Olivia Chan. She joined the program in 2019. Okay, what's quite amazing about Olivia is that before she joined my courses, she was so conservative that she has never bought a stock before. She has not even put money into unit trust before. All her money was in fixed deposit. That was how conservative she was. The first course that she took was the investor course, where she learned how to buy good companies. Then once she took that course, then she took the options course. And again, she has zero financial background, never bought stocks in her whole life, and she took the options course. But she studied it very hard, and today in our community, she's known as one of the top option traders. One of the top option traders. And she's now in her 6th year doing this. And what she has done, in fact, when she first started, she sent us her results every single month, right? And you can see, she made 8,000, 3,000, 2,000, 2,000, right? Very consistent. And mainly, how does she do it? Right? Selling cash secured put, CSP, and covered call, CC, and bull bang collar, right? This is called bull bang collar, right? So these are the various strategies that she uses. How long before she became a top trader? In less than 1 year. In less than 1 year. And she's someone with zero financial background, never bought a stock in her whole life. Now she's completely retired. She's a full-time trader, and she travels around the world and trades from her laptop, basically, right? This is another one of my students. He don't want me to mention his name because he actually is now started his own fund management company with a group of my other students. He said, I'm writing to express my heartfelt gratitude for being the most influential teacher, mentor, and advisor in investing and trading. This month, I continue to generate 150,000 in trading, all from options. My trading account shows 90K profit and 60K in another account using cash secured put and bull put spread extreme. You have changed my life since I joined your classes. And he's from the US, by the way, right? This was his account, you can see. I know it's a bit small, but yeah, he gained 96,000 US in net profit over there. Right. And more recently, Barryman, he said 2024 has been an incredible year of growth and learning in options trading with 400,000 in close profits. My God, this guy make more than me, right? While the success has been rewarding, there's no shortage of lessons, especially around the importance of position sizing to manage risk and sustain momentum. The yen carry trade volatility is one that comes to mind. Immensely grateful to Bang Fan Van and the rest of the PP team. All right. You can see his profit and loss over here. Oops. Right? Amazing. 464,000 in net profit in his account. Okay. Okay. Now, again, some of you may say, Adam, I don't have the cash to buy 100 shares. Can I still do this? Can I still sell puts and collect premium? The answer is yes. Would you like to learn how to do it with a small account? So the way to do it with a small account is using, ta-da, a bull put spread strategy. This is called a bull put spread strategy, also known as a put credit spread strategy. So this is a strategy on how traders can create regular income with limited risk and limited capital with a 70% or more win rate. Now, one reason why I love this strategy is because it's got a 70% or more win rate. I love high win rate. Okay. So let me explain to you step by step how this works. Now, you can trade this strategy on reversal patterns. By the way, how many of you yesterday you attended Alson's webinar and he talked about what we call bear trap patterns and bull trap patterns? Did you hear that? Okay, so those are what we call trend reversal strategies, right? Trend reversal strategies. So you can use this on Alson's trend reversal strategies as well, right? But you can also use this strategy on trend continuation strategies. Now, for today's example, I'm going to show you using trend continuation example. Because for beginners, I find that it is the safest, right? It is the safest. But you can also use it for reversal strategies, yeah? Now, first rule is only trade this on large companies. Only trade this on large companies with a market cap of at least 10 billion. So do not do this on small companies. Only big companies like Microsoft and Tesla and Apple, only big companies, okay? Next, make sure that the stock is on a clear uptrend. Make sure the stock is on a clear uptrend. So how would you know? So this is one way to tell using moving averages. Can you see this red dotted line, guys? Can you see this red dotted line? This is called the 20 exponential moving average. This blue dotted line is called the 40 exponential moving average. So when the 20 red dotted line is above the blue dotted line, that means the short-term trend is up. Okay? Now, then this blue line here is called the 50 simple moving average. And this green line is the 150 simple moving average. When the 50 simple moving average, blue line, is above the 150 simple moving average, that means it's on a medium-term uptrend. So we want to make sure the trend is very strong. The 20 must be above the 40 and the 50 must be above the 150. Are you clear, everyone? Is that clear? I repeat, the 20 above the 40 means the short-term trend is up. 50 above 150 means medium-term trend is up. So you want to make sure that the trend is very strong. Right. Next, once you identify as an uptrend, look at the wave pattern. Wait for a wave down. Now, check this out. Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. You must wait for the price to drop to a support level. To a support level. The support level could be a moving average or a horizontal support. Now, so because it's on an uptrend and the price dropped to a support, there's a high probability that the price will what? The price will what? Will continue the trend, right? The price will go up, correct? Not? Now, is it a guarantee? Is it a guarantee the price will definitely go up? Of course, there's no guarantee. In the market, there's no 100%, but it's a high probability. Understand? Okay, so once the price hits the moving average, and I think that the price has a good chance of bouncing up, what do I do? What do I do? I will what? I will sell a put option below the market price. I'll sell a put option below the market price. We call this out of the money put. So once again, why do I sell this put option? Because I want to collect what? I want to collect premium, right? I want to get free money. Yeah, I want to collect premium. Understand? Okay. Now, this is what we talked about earlier. But what's the problem if you just sell this put option? What's the problem? The problem is you'll be obligated to buy the shares if the price drop below this strike price, correct? But if you don't want to buy the shares, if you say, no, I can't afford to buy 100 shares, I don't want to buy the shares, then what you do is you simultaneously buy another put option below the first put option. Okay, you buy a further out of the money put option. So you sell a put here, you buy another put here. And the two put option must expire on the same day. Now, why? Okay, so this is like I sell insurance, but I buy reinsurance. Okay, I sell insurance, I buy reinsurance. Now, remember, when you sell a put, you are obligated to buy what? You are obligated to buy 100 shares, right? Can you see? But you say, I don't want the share. I don't want to keep the share in case the share collapse, right? So if you buy a put option here, then you have the right to sell the 100 shares. You see? So this one makes you buy 100 shares. This one let you sell the 100 shares. So you cancel off. You are protected. You are protected. Are you clear? Sell a put, buy another put. Sell insurance, buy reinsurance. You understand the concept? Now, do I use this method myself? Yes, I also use this method if I don't want to own the stock. There are some stocks that I want to trade, but I don't want to own the stock, or I think the company is risky. I will do a credit spread. So I don't have to take the shares. Right? Now, when I sell the put, I collect what? I collect money. So let's say I collect $5 here. Now, when you buy a put, must you pay money? Yes, you must pay money, right? But you pay less. So let's say I pay $4. So I collect $5. I pay $4. So net, do I still earn something? Yes, I still earn $1. This is called a credit spread. Yes, you need a margin account. In order to sell options, you need a margin account, right? Are you clear, everyone? Yes, same. No, different strike price. Different strike price. Later, I'll show you what is the strike price I use. Okay, clear? Now, some people will say, Adam, if you think the price is going to go up, why don't you just buy the stock? Why don't you just buy the stock? Or why don't you just buy a call option? Why must you be so complicated? Sell a put, buy another put. So complicated. Just buy the stock, buy the call option. Why don't you think I do that? Why don't you think I just buy a call option here? Or buy a leap? Why? Because if I buy the stock or buy a call option, I only make money if the price goes up. Can you see that? If the price goes up, then I will make money. But if the price goes sideways, I don't make money. If the price go down, I also lose money. So I only make money if the price goes up in the case of buying a call option. So it is called a directional trade. So the good thing about this strategy is the price does not have to go up to make money. So if the price goes up, I make money. The price goes sideways, I also make money. The price drop, I also make money. As long as it doesn't drop below the strike price. As long as it drop not too much, but so you can see that I have got a very wide profit zone. You see what I'm saying? Go up, make money, sideways, make money, down also make money. So this gives me a 70% win rate. I do not need to be right on the direction. Is that clear? Okay, very good. So one more time, huh? So look at this other example. Is this an uptrend? Yes or no? Yes, 20 EMA above 40 EMA. Red dotted line above blue dotted line. 50 moving average above 150 moving average. So the trend is very, very strong. Give me a second. Let me just wear my watch. Okay, the trend is very, very strong. Now, again, like I said, wave pattern. Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. Always wait for wave down, hit the support, then sell the put. Now, some of you would say, what strike price do I sell the put? What strike price do I sell the put? Yes, this is on daily time frame. I always sell the put near 25 delta. Okay, near 25 delta. Now I may say, what is delta? Okay, don't worry. In the course, we'll go into detail, but let me tell you, delta tells you roughly the probability of the price dropping below that level. So if I sell a put at 25 delta, what does it mean? That means there's only a 25% chance, the price will drop and stay below this strike price. Okay, so that means there's 70% chance it will not drop below this. Okay, so that's why I choose 25 delta. Okay, then I buy another put below the put. How much lower? I usually choose $5. $5 strike price difference. Okay, I usually choose $5. Now, some stocks are very high price, so I have to use $10 sometimes. But most of the time, I will use $5 strike. Got it? No, you don't need Oracle to get the delta. The broker will tell you the delta. Okay. So you win whether the stock price go up, go sideways, or go down. Can I move on, guys? So far, are you clear? Can I move on? Okay. So ideally, now this is not a must, but it's a good to have. Ideally, do it when the implied volatility rank is above 35%. So when the implied volatility is high, the option premium are more attractive. Yeah. And again, this will be in detail in the course itself, right? But it's not a must. Okay, it's not a must. Normally, I sometimes I don't even look at the IV rank. As long as the premium is attractive, I will take the trade. Okay, this is just good to look at. Yeah, but it's not a must. What is the date to expiration? 30 to 45 days. Same thing, 30 to 45 days. 30 to 45 days. Okay, so let me show you a real trade right now. Okay, a real trade right now. Now the market is closed. So when the market opens on Monday, the prices could be different. So this is as of Friday close. Okay, all right. So let's look at ASML. Can you all follow me, everyone? Okay, so let's look at a live example right here. Let's go to ASML. ASML. Okay. So first of all, is ASML on an uptrend? Is it on an uptrend? Is the 20 above the 40? Yes. Is the 50 above the 150? Yes. Is it on an uptrend? Yes. Now look at the wave pattern. Okay. Wave up, wave down, wave up, wave down, wave up, wave down. Now, after wave down, is it at a support level? Is it at a strong support level here? Yes. So I think there's a good chance it will bounce up, right? Okay, very good. So what can I do? If I think it's going to go up or it's going to stay there, I will sell a put option, correct? Okay, so hold on, let me get my drawing tool. Okay, so first I will sell a put option somewhere here, and then I buy a put option somewhere here. Okay, so let's choose the strike price. Okay, let's go step by step. So let me go to a trade here. Ta-da! Okay. So first, I will choose an expiration date. So 30 to 45 days. So let's say I choose this one. Okay. Expired 29 August in 41 days. Let me open it up. Okay. All right. Now, let's look at all the put options. So right now, the stock is at 734. I want to sell the put below the market price. Below the market price. So which one do I choose? Look at the delta. Look at the delta. Okay. So what did I say just now? Choose the delta close to 25 delta. Close to 25. So which one is close to 25? Either 26 or 24, right? Either one. So I could either sell the 695 or I could sell the 690. Okay. I always ideally want to sell the lower one because if I sell lower, the price can't hit as easily, right? Okay, so let me see if I can sell the 690. Okay. Now, if I sell the 690, hold on, okay. If I sell this put, how much premium do I collect? If I sell this put, how much premium do I collect? I will collect $10.95. Can you see? Now, if I sell the 690, then I must buy a put $5 below that. Right? Remember, I told you $5, right? Okay. So what is $5 below that? 685. Okay. So I sell the 690, I buy the 685. Now, I buy the 685, how much money must I pay? How much money must I pay? $9.75, right? Okay. So I collect 10.95, I pay 9.75. How much net do I keep? I keep $1.20. Is that a good deal? Is that a good deal? Okay, listen very carefully. Listen very carefully. If you take a $5 strike difference, which is what I normally do, you must collect at least $1. You must collect minimum $1. You cannot collect less than $1. If it's less than $1, do not take the trade. Do not take the trade. Must collect at least $1. Okay. So in this case, it's 120. It is very good. It is a very good premium. Anything more than $1, very good. Okay. So let me enter the trade. Okay. So first, I'm going to sell the 690. So sell, click on bid. Okay. Sell 690. Dong, okay. Then buy 685. Buy, click on ask. Click on ask. Dong, okay, there we are. Okay. Now, so can you see here? -1 means I sell one contract. plus one means I buy one contract. So I'm selling the 690, I buy the 685, I collect $1.20 credit. With this method, you don't need the money to buy 100 shares. Don't need, don't need, don't need. No more. This is for small account. Okay, you can do this with a very small account. Now the market is closed. Of course, the volume is low. Okay. So far, can you guys follow me? Okay, good. Now, let me show you. Okay, let me click on this and let me show you this first. So you can see what is the maximum profit I get from the trade. I get $120. Can you see? Can you see I get $120? Okay. That is the premium that I get. Now, what is my maximum loss? My maximum loss is $380. Now, some of you may say, Adam, you get $120 profit, but you are risking $380. You're risking more than you get. Are you crazy? Are you insane? Relax. Now, first of all, do you think that I can lose this 380? Do you think I could lose $380? Could I lose $380? Yes, I could if I do not manage the trade properly. If I enter the trade and the stock price drop below the strike price and expire below the strike price, yes, I can lose 380. Now, if this ever happens to you, you must ask your wife or husband to give you one tight slap on the face because you did not manage the trade properly. So what I do is I manage the trade. I will never allow this to happen. I will never allow this to happen. The moment the stock price drop and it's near the strike price or hit the strike price, I will cut loss. I will close the trade. So when I close the trade, I'll never lose 380. I'll lose a lot less. Let me see. How much do you lose? Okay, I'll show you in a while, all right? Just relax. Now, but I want to warn you, when you trade this strategy, you have to manage the trade. You cannot enter and go on holiday and forget about it, all right? If you forget about it and the price drop below the strike price, you can lose 380, right? You can lose 380. So please don't ever let that happen. Huh? Don't ever allow yourself to lose 380. That is crazy. That is crazy. Now, so let me show you what the profit and loss looks like on this trade. Okay, so this is what it looks like. Hold on, huh? Okay, there we are. So first, let me orientate you to this chart. Okay. Now, on the vertical axis here, this shows you the profit and loss. This is a zero line. Anything above this is what? Anything above this is profit. Anything below this is what? Loss. Okay, so this is the profit and loss. On the horizontal x-axis is the stock price. So the current stock price is $735. Can you see this? This is the stock price here. So the stock price can go up, the stock price can go down. You see? Right? Now, can you see this green line here? Can you guys see this green line here? Can you see this green line here? The green line tells you the profit and the loss on the day of expiration. So the day of expiration is on the 29th of August in about 40 days, right? Okay. So you can see that when it expires, what is the profit you will get? What is the profit you'll get? You'll get this green line. Okay. Now, look at this box here. Can you see this box on my bottom left? Can you tell me what the box says? I know it's a bit smaller, but can you see the green number? What does it say there? $120, correct. Okay. So the maximum profit is $120. Okay. Now, what happened if you enter the trade and the stock price crash? The stock price crash all the way down below 690, right? Let's say the stock price go below 690 and you let it expire in 41 days. Then what's the maximum loss here? Again, look at the green box. Look at the green box. What's the maximum loss? Yes, your maximum loss is 380. That's the worst that can happen. Now, will I ever allow myself to lose 380? Will I ever allow myself? Of course not. All right. That one, I will ask my wife to give me one tight slap on the face. So I don't. So instead, okay, now let me tell you the different scenarios. So, scenario number one, okay, scenario number one, right now, this is the stock price. Can you see that? So, if the stock price goes up, do I eventually make the 120 at expiration? Yes or no? Yes. If the stock price stays here, doesn't move, do I also make 120? Yes or no? Yes. If the stock price go down, okay, but it doesn't go below 690. Now, 690 is my cut loss price. Can you see 690 here? Okay, this is my cut loss price. Okay, so I've got a wide profit zone. Price goes up, I make money. Price stays there, I make money. Price drop, I make money, right? So in all these scenarios, I can make up to $120, all right? Now, the moment it dropped to 690, what do I do? I have to close the trade. I will close the trade. So how much would I lose if it drops to 690? Can you see this purple line here? Can you see this purple line? The purple line will tell me my profit and loss. Now, look at the box here. Can you tell me what is the loss I'll make? What's the number on the box? $99.20. Can you see? So my risk is $99.20. So listen, if the price stays in the zone here, if the price stays above 690, I will make up to 120. If the price hits 690, I close the trade, I will lose $99. So I'm risking 99 to make 120. Is that a good deal? That's not a bad deal, right? Now, what is the chance that it will drop below 690? What is the chance it will drop below 690? The chance is here, there. It's calculated using the software. It's 27.94% chance. Can you see? And what's the chance it will stay in this profit zone? 22.67 plus 31.58 plus 17.81. It's a 72% chance. So when I tell you that the win rate is 70%, it's not something that I'm guessing. It's not something I pull out of my backside. This is all statistically generated from the software. It is all based on mathematics, right? That's why I say it's like a casino. You have got the edge in your favor if you act like a casino. Okay? Jeff says, if the IV increase, could you lose more? Yes, possible. All right. So if the IV increases, you could lose more than 99.20. Yes, it is possible. So later I'm going to show you that when I calculate my loss, I will not take 99.20 because I want to be more conservative. I will say that I may lose up to 1.2 times of my credit. So my credit is 120, right? So the worst that can happen is I lose 1.2 times more than 120, which is 144. Okay, so I'm willing to lose up to 144. Even if I lose 144, I will still be very profitable over many trades. Okay, so must always give a buffer that can lose up to 144, which is 1.2 times the credit. Okay, now Are you lost already? Or still can understand? Again, I don't expect you to understand everything today. If you can understand 50%, it's a miracle. That's why our mentorship program, we go step by step. We got weekly live webinars and the course material. You can watch as many times as you like, lifetime access to the course material so that you will master this. Well, once you master this, it becomes a very lucrative business, right? To me, options is like a business. It's like an insurance business, right? Now, okay, let me run a bit more. Huh? So far, okay? Okay, let me hold on. Let me just rub this away. If not, it gets a bit confusing. Uh, okay. Now, can you see this box here? 20th of July. Can you see this? Now, once I enter the trade on 20th of July, let's say it's today, right? Now, as time passes, right, from 20th of July, it becomes 21st, becomes 22nd, becomes 23rd. Now, as time passes, notice what is happening to the purple line. As time passes, what is happening to the purple line? 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 What's happening? That's right. The purple line moves towards the green line. You see? So as time passes, your profit gets more and more and more and more and more. Right? Your profit increases as time passes, and your loss at 690 reduces. So that eventually on the expiration day, you can see that on the expiration day, even at 690, you no longer lose money. At 690, you actually make money. So your break-even point becomes slightly lower, right? Your break-even point becomes 688, right? So why I love this strategy? Number one, 70% win rate. Number two, as time passes, you get more and more profitable and your risk gets lower and lower and lower as time passes. But if you buy call option and put option, is the opposite. You buy a call and put option, as time passes, you keep losing money, losing money, losing money, and it gets riskier and riskier and riskier. You see the difference? Can I give you guys 2 minutes? Okay? I'll be back in 2 minutes because I need to run to the washroom. Okay, so 2 minutes and I'll continue. Okay, thank you for waiting. I'm back. Let me just share my screen. Are you guys learning a lot today? Learning something new? Great. Later, you have to listen to Bang Fan Ban, who is my grandmaster. He's the Yoda, all right? I'm only the Luke Skywalker. I teach you the very simple stuff. Bang will show you the more mind-blowing stuff. All right. So I leave the Grandmaster uh, to impress you more. Anyway, so where was I? Yeah, appreciate that. Okay. Yeah. So by the way, I just entered a bull put spread. By the way, these are bull put spreads, right? Let me just show you here. Right. Right. So you can see I entered a bull put spread on Essential here. Right. I entered there. I sold the 270. I bought the 265 AGX, ASML, right? So I just entered this trade a few days ago, right? I entered a bull put spread on ADSK, sell 270, buy 265, collected $1.10. This was notified to all my subscribers. And this trade is still open right now. Okay, you can see that ADSK is still above my strike price. So as long as it stays above 270, I will keep my $1,100 premium. Okay. Now, again, one of the things you must understand in trading is this. Can you win every single trade? Can you win every single trade? Of course not. There's no such thing, all right? In trading, you will have winning trade, you will have losing trade. And for this bull put spread, like I said, the win rate is 70% plus. Again, this is not something I'm guessing, is a mathematical fact. Okay. So what does it mean? It means that over 100 trades that you take, you should expect 70 win and 30 losses. This is the statistics. Okay. It's like casino cannot always win. Casino will lose money sometimes, but they must win more than they lose. All right. Now, and I told you earlier on that every time I enter a trade, I collect a credit. Now, what's the minimum credit I must collect again? Do you recall? What's the minimum credit I must collect? For, yeah, $1, at least $1, right? Times 100 shares, I need to collect at least $100 per contract. Again, you can trade as many contracts as you like. One contract, I need to collect at least $100. But if it's a losing trade, I told you I'm prepared to lose up to what? I'm prepared to lose up to 1.2 times, which means I lose $120. Now, even though I lose more than I win, it doesn't matter if my win rate is very high. You get the point? So out of 100 trades, I know I will lose 30 trades. I just don't know when the loss will come. Okay, it is a random sample. Okay, now each time I lose 1.2 credit. So that's minus 36 credits. Every time I win one credit, which is at least $100. That's 70 credits. So net 70 minus 36, do I make money? Yes. So this strategy has got a positive statistical edge in the market. When you trade, you need a statistical edge. It cannot be by luck. It must be a statistical edge. Now, translate that to numbers. Every 100 trades, okay, let's say I trade two contracts. Each contract I need to collect $100. So two contract I collect 200. Okay, and I'm willing to lose up to 240. All right. So out of 100 trades, I lose 30 trades. That's 7,200. Every win I win, 200, that's 14,000. So net, do I make money? Yes. Adam, is there a reason for the loss to be 1.2? Yes. Because if when volatility increases, then when you close a trade, you could lose up to that. That is from experience. Okay. So to me, this is one of my favorite strategies. Why? Because why do I like this strategy? Because number one, I do not need to rely on predicting the stock price direction. I don't need the stock price to go up to make money. Don't need, right? Price can go sideways, price can go down. I will still make money. It's mathematically proven to have a high win rate. and requires minimum time commitment. Although I put 1 to 2 hours a day, frankly, for myself, I spend less than half an hour. All right. But I mean, that's because I've been doing it for so many years. If you're new, yeah, maybe it may take 1 or 2 hours a day to look for the trade, to enter the trade, to manage the trade. But once it becomes a routine, I don't take more than half an hour. Okay. This is one of my students. He said, this is my options trading account. It's a small account. I started with 2,000 in January and added 12K in February. So total, he had 14K capital. Now he grew it to $50,000. All investors need to understand options. It helps to minimize risk and maximize return. You can see his net profit over 1 year, 40,800 US dollars, starting with a 12K account, right? Not bad, not bad. And this is a high Bang Pham Van Adam Khoo sharing my year-to-date result up 89%. No words can express my gratitude for all your guidance and teaching to make this happen. My favorite strategies are bull put spread extreme, and earnings probability spread. And then, so by the way, the main reason we use options is because it's a very versatile tool. It's like a Swiss Army knife. It allows us to profit under all kinds of market conditions. So whether it's a bull market, market go up, market go sideways, market go down, there are different option strategies to profit under different scenarios, whether high volatility or low volatility. Okay. So when using the right strategies, options can allow you to use lower capital to boost your returns and increase your win rates. Yeah. Now, options can be used both for investing and short-term trading. So in the options Wave Rider mentorship, you're going to learn over 26 strategies. Some of them are for investing, some of them are for trading. So in general, for long-term investors, options can be used for selling covered calls to earn monthly income when your stock goes sideways. You can sell cash secured puts and get paid to wait for the stock to drop to your buy level, or you can protect your portfolio during bear markets. So sometimes you may also want to buy insurance if there is a big bear market. But for me, I rarely do it, all right? Unless, of course, it's a very severe bear market, then sometimes I may also buy insurance, okay? We'll cover that in the course. Next, if you are a short-term trader, like yesterday you learned about Alson's swing trading, short-term trading with futures and all that, you can also use options to execute Alson's price action trades, right? You can combine both at the same time. So for trading, you can use call and put debit spreads, call and put credit spreads. And today I covered the put credit spread, right? This is what I covered today, this one. Okay. In the course, you will learn call credit spread, call debit spread, put debit spreads, diagonal spreads, which is Bang's favorite, one of Bang's favorite, bullish synthetic, which I also use a lot, and the bull Bang spread, which is his proprietary invention. All these are very powerful directional strategies. Then you also will learn strategies that make money when the market goes nowhere, when the market goes sideways, like the iron condor, like the Snipex that's used on the S&P index, and calendar spreads, which I think Bang will cover later. I think he's covering calendar spreads if I'm not wrong, right? And then you also learn event-based trading. So like if there's a certain event, like the Fed will announce interest rates, or company will announce earnings, and you have no idea whether the price will go up or go down, you can make money on the increased volatility, regardless of the price direction. So we call that the earnings probability spread and the earnings sniper spread. Many of these you will never learn anywhere else because they were invented by the grandmaster, right? Like the Snipex, the Bubang, and the earnings sniper was invented by him. I'm not so smart to invent strategy. I only learn the strategy and practice it, right? But he creates new strategies that you can't find anywhere else. Okay, so again, in total, there are over 26 powerful strategies that will allow you to profit under any market condition. Can you trade options on ETFs? Yes. Can you trade options on futures? Yes. Can you trade options on currency futures? Yes. On gold, on oil, on stocks. You can trade options on many things. You guys remember Brexit last time? Anyone remember Brexit? When the UK left the euro, right? I made a lot of money trading options on the pound futures, right? So we'll cover that as well. How do you trade on futures, option futures? Yeah. So, example, when the market is very strong, very bullish, what method do you use? You use bullish synthetic. You use bull call spread and callback ratio. If the market is going up very slowly, you use bull put spread, which I taught you today. You use bull put spread extreme. This is my only invention, okay? And cash secured puts. If the market is collapsing, you can use a bearish synthetic or a bear bang. You can use bear put spread, put back ratio. If the market is going down slowly, you use bear call spread. If the market is going sideways, use diagonal spreads or iron condors or iron butterflies or sell covered calls. Special events, you use the earnings, sniper, or probability spread. All right. So, like I said, there's a lot to learn. Today, I'm covering less than 2%. Okay, less than 2%, really. Okay. So people like Cheryl, she said, Dear Bang, I'm from your first batch in 2017. It took a couple of years, but this slow-witted student, she calls herself slow-witted, but I think most people, when they first learn, they find it tough. Even me, right? It's normal, okay? I'm proud to share 2024, I got 60% return across 205 trades with an average win of 76%. Okay. And then got Suran, he said, I want to take a moment to express my heartfelt gratitude to Adam and Bang Fan Van. I achieved a 36% return in 2024, remarkable milestone of 101% return on my investment since I subscribed to the investment course and iron options course in 2021. Right? So far today, I've shared with you two approach, right? Selling cash secured puts and selling bull put spread. Uh, Now, let me mention a third method very quickly. Okay, how many of you here have ever bought a call option before? You thought the stock is going up, so you bought a call option, or you bought a leap. Leap means a long-term call option. Anyone done that? Okay. Now, this is something I will never do. Bang and myself, we will never buy call options. We will never ever buy call options. Why? So even if we think the stock is going up, we will never buy a call option. We will never buy a leap. We will never do that. Why? Because the problem with buying a call option is you have to pay a high cost of the premium. Remember, when you buy call option, you have to pay a premium. We hate paying premium. We hate paying premium. Okay? And option suffer from time decay. We call it theta decay. So every day you hold the option is losing value, losing value, losing value, losing value. So even if the stock price goes up, but it goes up too slowly, you also lose money. Even if the stock price goes up, but it doesn't go up enough to cover the cost of your call option, you also lose money. You understand? So when you buy a call option, you must be right on the direction, on the magnitude of the move, and the speed of the move. And so the probability of making money buying call option is very low probability. Once in a while, you make a lot of money, yes, but long run, it's hard to make money. Okay? So for me, if I think a stock is going to go up in the long term, but I don't have money to buy the shares. What do you think I do instead? Instead of buying a call option, what do I do? Instead of buying a call option, what do you think I do? Instead of buying a call option, I will buy a bullish synthetic spread. I'll buy a bullish synthetic spread. What does this mean? Okay, again, this is taught in detail in the mentorship program, but I want to give you an idea. Okay, so don't ever buy a call by itself because you suffer time decay and you pay premium for no reason. Okay, so a bullish synthetic spread is when you buy a call and sell a put at the same strike price and the same expiration. Why? Because what happens when you sell a put? You collect what? You collect what? You collect premium. And this premium that you collect is used to finance the call that you buy. Yeah? You sell the put, the money you take from the put is used to pay for the call. So in the end, you don't have to pay any premium. It's a free trade. It's a free trade. Okay? And if you buy a call and sell a put at the same strike price, it is equivalent to owning the 100 shares at 1/4 of the cost. At 1/4 of the cost. Okay? So let me give you an example. You want to see an example? Okay. So let's look at this stock, for example, called Thermo Fisher. Do I have time? I still have time. Don't run away. You guys want to stay and learn this? Okay. So let's look at Thermo Fisher. Now, Thermo Fisher has been on a downtrend for quite a while, as you can see, because healthcare has been a downtrend, right? Now, it looks like it's bottoming, right? It looks like it's bottoming, and it looks like an early stage of an uptrend. So if you think that Thermo Fisher is going to recover soon, okay, what could you do? You could buy a call option, right? Now, let me show you what happens if you buy a call option, which I don't do. I explain why I don't do it, right? So if you buy a call option at, let's say, 420, all right? Okay. Okay. Now, the trouble is when you buy a call option, it's very expensive. Can you see? You are paying $22.60 to buy the call option. So times 100 shares, what is the premium you're paying? What is the premium you're paying? You're paying $2,000 in premium. Very expensive. All right. So to make money, the price must move up enough to cover the cost of this premium that you pay. All right. And what does the trade look like? Let me show you what it looks like. Okay, it looks like this. Can you see? Now, if you think that Thermo Fisher will reach $500, okay, so let's say your target is to reach, okay, let's say reach 475. You think it's going to reach 475, right? Now, at 475, how much profit will you make? If it goes to 475, how much profit do you make? You will make, you see the green box here? You can see the answer here. You make three, I see my eye also got problem. Hold on. 3261. Okay. You will make $3,261 if Thermo Fisher goes up, right? Can you see that? But if Thermo Fisher doesn't go up, okay, if it stays here or it goes up a little bit or it goes down, you will lose a lot of money. You will lose a lot of money because what happens as time passes? Can you see as time passes what's happening to the purple line? What is happening to your profit? what's happening to your profit? Your profit is dropping every day. Can you see? Because the option is losing value, losing value, losing value. And by expiration, if the price does not move, you will lose $2,000. You see? Now, so instead of doing this, what happened if I buy this put option at 22.60, but I also sell a put option at 4.20? Now, if I sell a put option at 4.20, how much money do I collect? How much money do I collect? I collect $25. So can I use this money to pay for this 22? I use 25 to pay for 22. Can. So do I still end up with a credit? Okay. So I buy this and I sell this. Can you see? I buy a call, I sell the put at the same strike price, and instead of paying $22, I collect $3 credit. It's a free trade. Not only is it free, I'm being paid to take the trade. Isn't that a better deal? Okay. And it is equivalent to owning 100 shares at a lower capital requirement. Now, of course, oops, Now, what is the profit and loss graph? The profit and loss graph is one straight line, which is the same as you owning 100 shares. It is no difference. I repeat, a bullish synthetic spread gives you the same profit and loss profile as owning 100 shares. It's the same profit and loss profile. Okay. Now, this time, if the stock goes to 475, how much do I make? Can you see the green box here? How much do I make now? I make 5,800. Is it better than the previous example? Previously, when you went to 475, how much do I make? I made less, right? I made 3,261. Can you see? Right? Now, you can use a bullish synthetic spread for investing, but usually I don't recommend it. I use it more for trading, all right, for trading, so that if it does drop instead of go up, I must cut loss. I must cut loss, and then you can see how much you lose when you cut loss, which is the same as cutting loss on owning the shares. There's no difference. Okay. So is this useful to know? Okay. Now again, if you are investing, make sure it's a very good company that you know is a tennis ball, right? And to me, Thermo Fisher is a strong company, right? Although the share price dropped a lot in the short term, but they will rebound eventually, right? So it's something that I personally invested in. Yeah. By the way, YY, in fact, he only uses bullish synthetic spreads now. He doesn't even buy the stock. He just uses bullish synthetic spreads in order to optimize his capital. Okay, so now you can ask him more when you want to chat with him online. Okay. So this was a recent trade I entered. I entered a bullish synthetic spread on LMT, Lockheed Martin, and I shared with my subscribers, right? So my stop loss was at 419, my profit target at 491, as you can see, and I closed it for 5,000 profit, right? 5,000 profit. Yeah. And I had a free trade, right? I entered a free trade, and I still made 5,000. Not bad. Okay. So why do I love trading? I love trading because, to me, it's the only skill that can guarantee me an income for the rest of my life. Nowadays I can, someone can get a bachelor, master's degree, but you can be replaced by AI. You can be replaced by someone smarter, younger, faster, who knows AI. But when you can trade the financial markets, no one can replace you. You can do it from all around the world and you are in control. right? You're in control of yourself, right? So let me introduce you to the Options Wave Rider Mentorship. Okay, so this is an entire mentorship program that we put together to help students. In the past, we only offered a course where you have to watch the videos on your own time, own target. And some people who are very disciplined, they can do it. But some people that don't have the discipline to watch all the videos themselves and they don't really understand, it was a challenge. So that's why we developed this mentorship program where it comes with a lot of live webinars regularly, all the time. Okay. By the way, like I said, this mentorship program is taught primarily by Bang Fan Van. Okay, he's the main teacher, not me. Like I said, I'm Luke Skywalker, he's Yoda, right? So, and he'll be coming on after me. So please hang on for his session as well. We're gonna learn even more, right? So Bang Fan Van, by the way, he makes a lot more money than me when it comes to options. Of course, investing I make more than him because I got bigger account. In fact, last year, you can see that he made over 1.1 million net profit just on options trading, which was 3 times more than me in terms of options, right? So because he trades options full time, he doesn't trade stocks, he doesn't buy stocks, he only trades options, right? And the other person who will also be in the mentorship program is our dear YY. Okay, and he is the only guy who also manages my company's accounts. So he trades my company money for my company, all right? And that's how much I trust him, all right? So far, he's made a lot of money for my company. You can see his last 12 months, he made 88,000 net profit at 66% return across all his different strategies. This is his long-term return. You can see over the long-term return 250%, beating the S&P 500. And since 2017, how much did he make? Net, I didn't calculate lah. A few $100,000 anyway, right? Okay, so what is in the mentorship program? The first thing is the 2 trading courses. So you have got level 1 trading course and level 2 trading course. Level 1 is called Iron Shell. Level 2 is called Iron Striker. And in these 2 courses, it covers all the 26 strategies. Now, for level 1, you'll be covering all these parts. Number 1, option basics. So we, of course, assume that you don't know anything about options. They're totally zero. We start the ABCs to understand what's a call option, what's a put option, what is the date to expiration, what's the strike price, right? We go through the basics, how to set up your charts and tools. And then option strategies for investors, like selling covered calls, selling cash secured puts. And part 3, more aggressive strategies like bull call spread and bear put spread. Part 4, you learn moderately bullish and bearish strategies like the bull put spread and the bear call spread. You learn the tools of the trade and additional bonus strategies like the cash flow wheel and how to hedge your portfolio in a bear market. So that is level 1. Level 2, you will learn other moderately bullish and bearish strategies like Jade Lizard. I also trade Jade Lizard. Crouching bull strategy, bull put spread extreme, diagonal spread, bull bunk collar, and DS hammer. All the ones with the TM are trademarked because we invented it. You can't learn it elsewhere. It's our own invention, right? Market neutral strategies like Iron Condor, calendar spread, and Snipex. Aggressive strategies like synthetic long and short, bull bunk. Special situation strategies, which I mentioned earlier on. And of course, you learn all about trading psychology and money management, how to manage your risk and build a profitable options trading business. You learn about how to roll options. You learn about how to use the trading platform. using both interactive brokers and tasty trade, as well as bonus strategies like the back ratio and the collar strategy. Okay, so this is Alexander. I think he's from Singapore, if I'm not wrong. He said, I'd like to take this opportunity to express my gratitude to Adam and Bang for your exceptional investment and trading advice. Thanks to your guidance, I'm able to identify and invest in solid companies. By incorporating options trading, I have not only recovered all my previous losses before the cost, including the cost and subscription fees, but also achieved a decent profit. My investment and trading journey would never have been as successful without your constant guidance and invaluable lessons. Right? He hit 300%. Amazing result. James said, my options trading account up 35% year to date using cash secured put, covered call, and bull call spread. Right? This is Mike. And I mean, the list goes on. You can go and read all this. Now, how many of you have some of these common trading fears starting? Like, I'm a total newbie. What if I fail? Or this is too complicated for me. Or I'm a slow learner. I'm afraid to start. What if I make the wrong trade? Any of you have some of these concerns? All of us do. All of us do. Okay, if you don't have these concerns, something's wrong with you. When Bang first started, we had all the same fears. It's like learning to swim the first time. It's like learning to drive the first time. Now, let me ask you this. How many of you can drive? How many of you can drive? How many of you can swim? Let me ask you this. How come you can drive? How come you can swim? Because it was not easy when you first started, right? Now, I don't know about you, but to me, when I first learned to drive, I found it very scary. I found it very confusing. I had to step on the clutch, change the gear, look at my blind spot. I was like, my God, how to focus on so many things, right? Swimming also. But how come we can do it? I tell you why. Because to many of us, we said that I must learn to swim. I must learn to drive is a life skill. And because you said that is something I must do, what happened? You didn't give up. Even though you failed your driving test a few times, you keep taking the driving test until you pass because you say, I have to learn to drive. So you find that in life, when you are committed to something, when you say, I must learn this, it's a life skill, you will find a way. I always say in life, when you're committed, you will find a way. But if you say, oh, it's nice to learn to swim, it's nice to learn to drive, it's nice to learn options, you'll never learn it. Because you will always give yourself excuses. It's too difficult, I don't have the time, I'm too stupid, I'm too old, I'm too young. You will always give some crap excuse, seriously. My oldest student, one of the oldest, Venki, right? Venkat. He's 80 years old. No? He took the options class at 80, 3 years ago. He was totally blurred. So today he's 83. No, you see, yeah, he's 83 years old now. He's trading options like a champion. He flew all the way down from Texas to Singapore for one day to meet me and thank my whole team. 83 now. Trading options every day. So don't tell me you're too young, you're too slow. Okay? I've got by the way, one of the things is my CEO, Patrick, he also trades options every day. And his son started trading options at 15 years old. And now he gave the son 100,000 US to trade for the family. And the son is now, how old is the son now? Son is going army. He's 18. He's been trading for 4 years. He's making a few thousand US every month now. All right. And then he told his father, who's my partner, he said, I don't want to find a job anymore. After I finish army, I will trade full time. The father, no, you go university, get degree. Don't sway the family. Anyway. So, yeah, I mean, it's good to have a job, good to get educated, but this gives you another source of income, right? So what you need is a system to guide you through the whole process. Okay, you need a system to guide you through the whole process. So this online mentorship is 1 full year where you'll be coached by Bang, YY, and yours truly, and our team of coaches. So what does it consist of? First, you get the 2 courses where you can watch anytime, anywhere. It's pre-recorded. You can watch as many times as you like, and you will get access to it. All right. Now, then every 2 months, there'll be an onboarding workshop for beginners, which is live. This is live online. You will learn how to set up your trading account, how to place your first order, how to use our exclusive tools, and more to get you started. Now, must you use real money when you first start trading? Must you use real money when you first start trading? No, do not use real money. When you first trade, always use a demo account. Always use paper trading first. It's like learning to fly a plane. Do you think when the pilot learned to fly, they put him in a real plane with real passengers first? Of course not. What happens? He always goes in a simulator, right? And he'll take off land, take off land, take off land many times until he can do it perfectly. Then they give him a real plane with real passengers. You follow? Same thing in options trading. Please don't use your real money. Please don't use a paper account because you are sure to make mistakes at the beginning. Make all the mistakes with the paper account. Crash the plane with the simulator. No one die. Okay? Only when you are familiar how to do it and how to make money, then you use real money. Is that clear? Now, one of the things I love about trading is that, to me, in my mind, it is actually less risky than starting a business. Now, think about it, right? If you start a business, like you want to start a restaurant or start a shop and all that, can you start a demo shop, a demo restaurant, and make sure that you can make money first before you start a real restaurant? You cannot, right? You have to actually start the restaurant and you have to come up with at least what, $500,000, $1 million to pay the rent, get the staff, renovate the place, right? And if the restaurant fail, how much you lose? If your shop fail, you lose everything, right? And you should know that the chance of a business succeeding is less than 50% chance, But in trading, you can start with a virtual account. You can go into the simulator and crash the plane 100 times until you can fly, then use real money, right? Okay. Then every month you will have strategy deep dive sessions with Bang and the trading coach. All right. So YY and Bang, they will go through lesson recaps, strategy application, detailed case studies, and latest market examples. There'll also be a monthly e-gathering and live trade hunt with Bang Fan Fan. So Bang will show you live how he hunts for trade when the market is open, how he entered the trade, how he managed the trade, how he closed the trade. So these are monthly e-gatherings. Okay. And there's also a private chat group for all the option traders to discuss trades every day and to ask questions and so on and so forth. And there'll be quarterly trading psychology classes with me, right? I'll be handling the trading psychology part of it. Bang Fan Van will be covering the live strategy part. But the course itself is taught by myself and Bang together, all right? We both teach the course itself. Okay, so the 2 courses, Options Iron Shell and Iron Striker, you get lifetime access. Okay, it's a lifetime access. As long as you live, you can watch the courses. It is on demand, watch anytime, anywhere, like Netflix. It is pre-recorded. So this will cover all the strategies and case studies. Okay. Then the online mentorship. This is the live webinars. Okay, the live hand-holding, the live monthly gatherings, the live trade hunt. This is 1-year access. Okay, so monthly e-gathering and live trade hunt, monthly strategy deep dive webinars, options traders discussion group, quarterly trading psychology, onboarding. This is 1 year access. Okay. So the total retail price for this entire thing is 2,997 US dollars. And when you enroll now, you will get extra 2-month free mentorship, right? So total how many months? Total 14 months of live mentorship, but the courses are lifetime access. The courses are lifetime access. That one, there's no expiry, okay? So when you enroll now, you get 40% off the mentorship program. So that's only 1,798. And I can tell you that the value you're getting, all the strategies you're learning, the live webinars and coaching, it is a steal. Nowhere else out there can you find another options course that can match this course. Okay. And Bang, myself, and YY, I would say, correct me if I'm wrong, okay? We're the only people who show you our live trades, who show you our live account. There are many people out there who teach options. You ask them to show you their live account. I think most of them will not dare to show you because they probably don't make money, right? They make money only once in a while, but they don't make money consistently. Ask them to show you their live account, show you their results. If they dare not show you, it's bullshit, okay? So click on the link in the chat box or scan the QR code and you can get this mentorship program. Now, after 14 months, if you want to continue the mentorship, you can, right? There's a renewal of $899 US for second year onwards renewal if you want to. Yeah, but I think most people, they say 14 months is enough mentorship, right? Because they already master all the techniques, right? But if you want to continue, yeah, sure. Yeah, $899 for second year renewal. All right, so I'll leave you guys to enroll right now, and I'll do a quick Q&A in a while. Yeah, and of course, coming up after this, we'll have Grandmaster Bang himself sharing another strategy, right, of making money when the market goes nowhere. Right, so 1,798 US dollars, grab it right now. It is a great deal. You cannot find this offer anywhere else, I can tell you that. No way. Okay, so all it takes is for a few good trades to make back your mentorship fees. And most of my students, they make it back many, many times over. All right, people like Asanka said, you know, I'm pleased to let you know that my portfolio has grown 28% in the last 7 weeks purely from options trading, which helped me to recover all my course fees many times over. All right, so 40% off and it's 1,798. All right, right now, okay? All right, so I'll be back in about a minute or so, and I'll do my best to answer your questions. And in the meantime, do register. All right, so I'm back. Let me see. I think a lot of the questions you have, my coaches can help to answer. But if there are some questions that I can take, let me also take some of these questions. I need to put on my glasses to read because I'm getting old. Can't read anymore. Okay, give me a second. What percentage do you cut loss on your synthetic trade? Okay, so my cut loss level is not based on a percentage, it's based on what we call the swing low. And it's really up to you where you want to place the stop loss, right? So, for example, for Thermo Fisher, if I'm looking at a medium term trade that it can go to $500, right? Then I may put my stop loss, somewhere here below this swing low here, right? I could put my stop loss somewhere there. So I now put a stop loss below a certain swing low, so I can give myself a bit of room to move, right? So there was one question over here. Uh, Okay, so CS Chiang is saying, can you explain your thinking on a bullish synthetic spread versus a vanilla long call on the downside? So, so CS, again, you must understand that when you enter a bullish synthetic spread, it is equivalent to buying 100 shares. It's no difference from buying 100 shares, except that you do it with less capital required. Okay. And the question is it an investment or a trade? If it is an investment in a great business, then there's no stop loss. Okay, there's no stop loss, there's no cut loss, because even if the price drops, I know it will rebound eventually. So it's all about having the holding power to hold on. All right, for bullish direct spread. And in the event that the price goes below my short put strike, I will make sure I'm not assigned the shares. So I will roll the put before expiration so that I'm never assigned the shares. Okay. But if it's a trade, then I will have a certain price where I'll close the bullish synthetic spread and I'll cut loss at the price. And of course, I need to know how much I will lose in that scenario through the profit and loss chart that I look at, right? So for example, for Thermo Fisher, if I put my cut loss at $400, let's say I put my stop loss at $400, then how much will I lose? Okay, if I have a stop loss here, the moment it goes to 400, I close the trade. My loss will be how much? My loss will be look at the green number 1684, right? So my loss would be 1684, and my potential profit, if it hits my 475 target, I'll make 5835. I'll make 5835. So I'm risking 1006 to make 5008. Now, is that a good risk to reward ratio? I think it's not too bad. Oh, I forgot to share my screen. Okay. Sorry. Sorry. Okay. Okay, let me explain that again. Hold on, Where was I? Okay, so let me explain it again. Yeah, so for the case of Thermo Fisher, right? So like I said, if you think that this is the start of a reversal, right, and you're buying here, for me, I could put a stop loss somewhere here below this swing low to give it more buffer, right? So my stop loss would be somewhere here. My stop loss would be about 400, for example, and my profit target would be about 475. So in that case, you can see that if the price drops to 400 here, I will close the trade. How much do I lose? Can you see the box here? How much do I lose? What's the number there? 1673, right? I will lose 1673. And then if it goes up to 475, which is my profit target here, I'll make 5835. I'll make 5835. So I'm risking 1673 to make 535. So is that a good deal? Is it a good risk reward? Not bad, right? Yeah. So yeah, so it's how you structure the trade basically. Okay. So for selling cash secured put, what should we do if the option buyer exercises the option before the expiry date? Okay, no problem, right? So if the option buyer exercises early, you get assigned the shares, correct? And you say, I don't want the shares, I don't want the shares. Then what do you do? Then you immediately sell the shares. No problem. You sell the shares and you get your cash back. And then you sell a new put to reinstate the put that got exercised. So you sell a new put with a new strike price or the same strike price and a further expiration date. Yeah. So never be afraid of being assigned the shares. Never be afraid. Because once you assign the shares, you can just sell the shares immediately and get the cash back. Right? It's like once you get the baby, I don't want the baby. Give away for adoption. No problem. Okay. Yeah, horrible example. But I'm just saying it in humor and fun. Yeah? All right. What is my favorite technique I use daily? It is selling cash secured puts, which I mentioned. Yeah. Is selling lead puts a good income opportunity? No, I don't sell puts more than 45 days because if you sell options more than 45 days, the theta decay is very slow and is your profits come in very slow. So always sell 45 days or less. Olivia, I'm sorry, I'm not familiar with smart strategies. Is that a broker or something? I'm not too familiar with that. Do I sell weekly options weekly? To me, it doesn't matter whether I sell monthly or weekly expiry. It doesn't matter. It doesn't matter to me. To me, like I said, my DT is always 30 to 45 days. Okay, so Chin Chi is saying, what is my recommended fund allocation across long-term investing for growth, for dividends, for trading? There's no right or wrong because it depends on what you're comfortable with and depends on the size of your liquid net worth, right? So there's no hard and fast rule, right? So for example, for myself, in terms of my investments, about 60% are in capital gain, 40% are in dividends, right? And based on my overall liquid net worth, I'm using about 15% to trade options, right? So that's for me. For Bang Fan Van is the opposite. For Bang, he is 100% into options, 100% into trading. He doesn't invest in any stocks. And for Alson, I think he also doesn't hold any stocks. He's also 100% in trading. So there's really no right or wrong. It depends on what are you comfortable with. Okay. Ethan is asking, how about synthetic trade? Now, for synthetic trade, I do not choose 30 to 45 days expiry. For synthetic trade, the date to expiration doesn't matter. Okay, I tell you why. Because whether you choose 60 days or 90 days or 100 days to expiration, it doesn't matter because the premium from the put you sold will pay for the call you bought. So I normally would choose a very far expiration. I normally would choose, 60 to 90 days, right? Because it doesn't cost me more to choose a longer expiration date. You get what I'm saying? To cut loss for bull put spread, you simply have to buy the put back, right? So for example, like right here, okay, so you can see I've got a bull put spread on Autodesk. Can you see this? So I sold this bull put spread at $1 here, $1.10. Now it's 46 cents. So if I want to close this, I just have to close that, close the trade, and I put in the price I want to close it. So I want to close it at, let's say, 45 cents. I want to close it at 27 cents, right? And then I submit my closing order. Yeah. So again, all this will cover in detail in the mentorship. How to close the trade, how to open the trade is all that. Right? How do you monitor your trades when US has a 12 to 13 hour time difference? Oh, okay. So I only look at the market. So the market opens at 9:30 p.m., right? So I will normally look at the market when I'm free, which is normally about 10 to 10:30. I'll look at the market for half an hour, and that's it. And if there's a trade, I enter, and there's no trade, I don't enter. And then I will look at it again before I sleep. So just before I sleep, I'll just take another 10-minute look, and that's it. All right. So at the most, I look at it for half an hour a day. That's it. Right. Must I stare at it every second? No, right? Unless I can see that the price is coming to my stop loss price, right? And then before I sleep, I'll close the trade. You can close the trade anytime. Of course, you can close the trade anytime. You can open it anytime, you can close it anytime. Okay. Okay, guys. So thank you for joining me today. All right. So I do hope you have taken advantage of this mentorship program. Again, 40% off, 1798. Go grab it. And again, limited time offer. You get all the bonuses when you grab it as soon as you can. Yeah. So thank you for listening. And the next session coming up is from Bang Famban. You gotta listen to him, right? He's the grandmaster of options and a very, very nice guy as well. All right. So take care and I'll see you soon.